Hello, everyone. Jeffrey Tesch, CEO of RCN Capital here. Welcome to the monthly market update. And we have a special guest, Jacob from Bridge Loan Network.
Very glad to be here, Jeff. Thank you.
This is awesome. Folks, buckle up. This is going to be outstanding. And of course, our expert in the marketplace, Rick Sharga. So good to have you on board.
Always fun having a conversation with you, Jeff, and good talking to you too, Jacob.
Always good, Rick.
Awesome. So good. So let's get right into it. Here we are. The latest investor sentiment survey from RCN Capital has been printed and just came to market. And we also have some breaking news in that we have put together an investor sentiment index. Rick, I know a ton of work went into this on RCN's part and on your part. Maybe you could just take the audience through sort of why we created, what it's measuring, how people should use it to their advantage that are in the investment community. And let's talk about that a little bit.
Yeah, this index was a year in the making. A lot of people spend a lot of time and energy putting it together. And we believe it fills a void in the marketplace that existed prior to this. We've really not had anything that took a look at residential real estate investing as a category and would give us a snapshot of sort of the mood of the people that do all of this investing. Are investors optimistic or pessimistic about the future? How do they feel about current market conditions? And as part of our survey that we've now done for 5 quarters, we were able to capture information and put together this, as I said, snapshot of how investors feel at any point in time. We measure 4 basic questions. We ask investors if they feel the market today is better than it was a year ago. We ask them about their expectations for the market conditions 6 months out. We ask them if they're planning to purchase fewer, the same number, or more properties than they did a year ago. And we're asking them if they expect home prices to go up, stay the same, or go down. We weight those questions a little differently depending on the question itself, and put together a weighted average of these things that will track investor sentiment over time. What was really interesting about this first one, and probably I know it was coincidental, but we probably couldn't have asked for a better debut index. We saw a 16-point jump from the prior quarter in investor sentiment when we did this first index, and it's the highest positive rating we've seen since we started tracking this data. So the plan is to put this out quarterly for professionals who serve investors in the industry. Certainly something they should be looking at on a regular basis to figure out what the mood of their customers might be. Or should they anticipate, strong business? They have to hunker down and get their share of a less positive environment. And for investors, it's probably not a bad thing to be looking at to see what your peers are thinking across the country. And so we're really proud of this first iteration. It's similar to other indexes that you see on the market. One of the more quoted ones is the Builder Sentiment Index that's part of the real estate ecosystem, and we believe over time this will be the go-to source for people trying to figure out what investors are thinking.
And Jacob, I want to bring you into the conversation. Over at Bridge Loan Network Software, there's so much going on with investors coming to you, using your tools. But at the end of the day, something like this, the investor sentiment, you must hear it all the time. Is now the time? What's happening? What are other investors doing? And I feel like this index is really going to take not only your customers, but the industry really by storm.
I mean, I think Rick said it best, right? This is something that's lacking in our space. And I think that the smart investors in our community are going to take this and leverage it for what it's worth and help make the correct decisions for them, their business, and the future of their business. we hear from our partners all the time that this type of data is what they're looking for on a daily basis to help make those decisions. And like you also said, Rick, to inform their clients. If you're a lender or a broker in our space, you can also use this information to educate your own clients to help them make better deals, make better decisions, and ultimately bring you more business.
Rick, what are your thoughts on how investors will be able to use this index to help, at least anecdotally, plan their future?
Well, a couple of the items that make up the content that we create the index from are predictive in nature. Are you planning to buy more properties or less properties? And if I'm an investor budgeting out for the next year, making my business plans for the next year, probably not a bad thing to know what my peers are thinking that they're going to be doing in that same period of time. Should I be planning to buy and flip, or buy and convert into rentals more properties or less properties? I think that's the kind of data that will be useful from a planning perspective. The other is, and again, we're not talking about necessarily PhD economists that are the people answering these questions, but we are talking about people who are actually out in the field on a day-to-day basis and get a real sense of what the numbers are when it comes to prices and pricing trends. And so just being able to get a sense again of what the investor community collectively feels is going to happen with home prices is I think very relevant. So there are things I think you can use as an investor, gauging how your peers feel about market conditions going forward. If we had an index that suggested that the outlook going forward was particularly negative, if I'm an investor, I want to take a look at the reasons why and maybe approach the coming months with a little bit more caution than I'd planned on. You don't want to be the one going the wrong way when the market is starting to show some storm clouds. So I think there are pieces of this index that could be very, very useful for investors in planning and sort of in comparing what they're seeing compared to what their peers are seeing across the country.
So you mentioned that investor sentiment is up 16% over the previous quarter, which seems to me is a really big move. What you're seeing in your data points, what is driving this, at least from what you can see in the marketplace?
Well, there are some things that are showing up in the data and some things that you can kind of connect the dots anecdotally. In the data, we are seeing that while home prices are going up, they're going up a little more rationally than they were a couple of years ago. We are seeing a little bit more fix and flip activity than we've seen in previous quarters. And so both of those are indicators that maybe the market is starting to become a little bit more positive for fix and flip investors. Interestingly, we're seeing rental rates do different things for different types of rental properties. If you're a multifamily investor right now, asking rents are basically flat on a year-over-year basis, and in some markets are actually going negative. On the other hand, if you're a single family property rental investor, like most RCN borrowers are, we're seeing asking rents go up between 2 and 3%, and in some markets as high as 6% on a year-over-year basis. So I think there are components that we're seeing that make investors a little bit more positive about future prospects than what we've seen in the environment over the last couple of years, when mortgage rates were going up, when property values were going up at double-digit rates, where there was massive competition from traditional home buyers and from institutional buyers. So a lot of these conditions seem to have settled down a little bit in the favor of small to mid-sized investors.
And Jacob, when you're talking to the customers using your software, are they optimistic? Is this sort of a 16% number translating into boots on the ground that you deal with every day?
Yeah, what we're hearing from a lot of our lending professional partners is that because of this kind of change in the overall investor sentiment is that it's easier to sell these products now. It's easier to go out to your clients and sell these maybe more obscure products that, a couple of years ago were very hard to push, because these investors are now a little bit more open and a little bit more optimistic. A lot of our partners are hearing that these products are easier to sell in today's environment.
That's interesting. And that's a change, Rick, right? I mean, it was only just a few months back when the doom and gloom was much more, I mean, it was everywhere.
Well, look, the housing market today is kind of tough to get excited about. Let's be honest. We have now had 34 consecutive months where we've sold fewer existing homes than we did the year before. I'm not sure if that's a record, but I'm not familiar with another time period we've gone through that's that long. That's almost 3 years in a row where we sold fewer properties than we sold the prior year. That's a long time. Home price appreciation is slowing down. There are markets like Boise, like Austin, like Seattle, where we're seeing prices actually decline year over year. So, the combination of fewer sales, of home price appreciation slowing down, of affordability being at all-time lows, it's been really difficult for investors over the last couple of years. And investors who had financed rental properties with short-term financing a couple of years ago, or bought fix and flip properties at market peaks a couple of years ago, right before mortgage rates doubled, really got caught holding a bag, and not a bag full of money by any means. A lot of those rental property investors, when their rates reset or when they had to refinance, simply could no longer make the numbers work, because you're talking about financing costs doubling. And a lot of those fix and flip investors who purchased a house at a certain price, anticipating they were going to be able to sell it at a much higher price, suddenly found that their buyers couldn't afford the higher price anymore because mortgage rates were up. So I think we're coming out of a very, very gloomy period for investors who were looking at things in the short term. And we probably saw the worst of that, now in the rearview mirror, in terms of those short-term investment problems. And again, as mortgage rates have settled down, we're seeing more inventory coming to market. There's a very good chance that because inflation is coming down as quickly as it is now, the Federal Reserve will start to cut rates in the fall. So I think there's just a lot of things that investors are looking at saying, okay, the worst is over. That bad time is behind us. It's not, we're not printing money today, but it looks like it's going to continue to get better as we move forward. And I think that's probably what the data in the summer index told us.
So some of the concerns that have popped up in earlier surveys are back again. Recurring points of interest, 74% mentioned high cost of financing, 45% noted lack of inventory. These seem to be recurring themes that are weighing on investors month after month after month. And you wonder, while at least I can tell you at RCN, we're busy. So certainly some investors are pulling the trigger, but I wonder how many investors are still on the sideline waiting for the cost of financing to come down, waiting for the inventory to increase.
And I'm sure there's probably a whole boatload of people out there in that section, Jeff, but I think this is why things like this investor sentiment survey are so valuable and so important, is because an investor could look at this information and kind of gauge the market and get a better idea of what everybody else is thinking, but also game plan for their future investments as well.
Yeah. What's interesting, Jeff, is that, some third-party data we're seeing from firms like CoreLogic are indicating that the level of investor activity, particularly small and mid-sized investors, is actually not slowing down. It's at worst plateauing, but in some cases actually maybe increasing slightly. And you compare that to traditional home buyers right now, where activity is significantly lower. And so wouldn't be a surprise if we see at the end of the quarter, when reports come out, that investor activity is accounting for a higher percentage of the overall number of sales being done in the residential market, just a data point we were talking about off screen earlier. I noticed today, two reports came out for June. One was that pending home sales were actually up year over year for the first time in many months. But at the same time, the number of purchase mortgage loans that had been applied for was down both month over month and year over year. And so, the quick takeaway might be that, hey, we might be seeing more cash purchasers, but we might also be seeing more small investors who are using private lending rather than getting a traditional mortgage to buy these properties. So I think investors they've certainly helped keep the market from falling further. I think they're still maintaining a fairly consistent level of activity. And just to get to one of the points you mentioned, Jeff, investors are citing the high cost of financing as the number one challenge they're facing. By the way, that's been consistent in all 5 of the quarterly surveys we've done so far. But if you look at what they're saying comparing today's market in the survey to the future market, the high cost of financing is still the number one challenge they're expecting 6 months from now, but the percentages are going down. So you went from 74% today to, I believe it was 67% 6 months from now. So they're looking at the future and saying, we believe things are going to probably start to get a little bit better from a financing standpoint. And so that, none of the individual challenges are necessarily surprises. But the fact that they're cognizant enough of market dynamic shifting that fewer of them expect the same degree of difficulty going forward, I think is very telling.
So I'm going to use a word now that used to be run of the mill, but it's become a bad word, and that's insurance. Yeah. I'll tell you, it used to be just something an investor knew they had to get before they closed a loan. And now all of a sudden, it has become a really, really big deal in penciling out these particular properties. Where are we going with this, Rick?
Well, I wish I had the answer to that one, Jeff. I'd write my book, do my book tour, and retire on a private island in the Caribbean somewhere. It's a real problem. I was talking to somebody at a conference a week or so ago who mentioned that the combination of higher insurance and higher property taxes was going to increase his monthly mortgage payment by $800. And he grumbled about it, but also recognized that he was fortunate. He could handle that. He wasn't going to be happy about it, but he could handle it. But for a lot of homeowners, that might be the difference between I can stay in my house and I can't stay in my house. And for a lot of investors, it becomes a real question of, can I afford to invest in this property and can I make it pencil out? So if you're in a market like Florida, we're seeing homeowners insurance double and triple on a year-over-year basis, if you can get it. And there are some markets where insurance companies are simply not writing new policies. If you're in California, we're not seeing the same averages, but I can tell you that where I live in Southern California, my insurance carrier tried to double my rates last year. I wound up going with another insurance company at a slightly higher rate, but my rates are still up twice what I paid a few years ago. And if you're in Texas, we're starting to see the same thing. In fact, those 3 states, California because of wildfires, Florida because of floods and hurricanes, and Texas, oddly enough, because it is the severe hailstorm capital of the United States, which causes billions of dollars in damages. We're seeing those 3 markets have the most rapid increases in insurance rates, but the insurance companies probably won't be able to cover all their losses because they won't be able to jack up the rates high enough in those individual states to break even. And so pretty much everybody is going to start to see their insurance rates go up a bit. So if you're an investor, you really, really need to be factoring that into your purchase cost and into your ongoing operations costs. I mean, if you're a fix and flip investor, it's a short-term issue. But you also have to realize that from an affordability standpoint, your buyer is probably going to be able to afford less home because they're going to be paying for more insurance. And if you're a rental property investor, even more important, you have to bake that into what your rent is going to be in the long run. And God forbid you happen to be in one of the markets where they've now implemented rent controls, and you're allowed to raise your rent 3-4% a year, but your insurance cost goes up by 100%. That's bad math. So our investor sentiment survey, indicated that, and just to kind of put a fine point on it, Jeff, 100% of the investors we surveyed who invest in Florida said they had an issue either with insurance costs or the unavailability of insurance. 100%. The numbers in California weren't much lower. They were in the high 90s. And across the country, I believe we were looking at something like high 60s or low 70% range of investors who'd experienced some issues. So it's a real problem. It's something investors need to be paying close attention to. And I don't know that there's an easy solution, because we're having more and more of these extreme weather events that are causing so much damage.
Yeah, another new item in the investor sentiment survey this quarter was the problem of squatters.
Yeah.
Most of us have seen the news feeds and some of the challenges that different communities are having with squatters, but this really hits home when it ends up in the RCN sentiment survey. We saw a number of 76% of respondents saying that this was a problem in their local market,
Yeah.
which really surprised me, Rick.
Well, people need somewhere to live, I guess. And whether it's their ass or not, maybe they feel compelled to jump in. Squatting has been a problem for a while. It became, oddly enough, a little bit more of a problem during COVID, because local sheriff's departments were loath to try and go evict somebody for fear they might wind up catching COVID from the squatters. And once people get established, sometimes it's really hard to get them out. There are well-meaning municipalities that make it difficult to evict squatters, even though they really have no legal right to be there. We have seen some laws passed recently in Florida. There was some legislation passed that is pro-investor and anti-squatter. We'll probably see more laws like that being passed. One of the interesting, more granular data points in the survey this quarter, Jeff, was that more fix and flip investors had experienced a problem with squatting personally than rental property investors. And that could just be because the fix and flip investors may be buying more distressed properties, maybe are more likely to be buying vacant properties, whereas some of the rental property investors may be buying properties with tenants already in place, or properties that don't require quite as much work to get the market ready. But yeah, it's a problem. It's really kind of interesting because vacancy rates among single family residential units across the country are almost at all-time lows. So it's kind of ironic that with fewer of these vacant properties being out there, it seems like more and more of them are occupied by people who shouldn't be in them.
Transitioning into sort of the optimism, Jacob, one of the things that came out of this go around with the investor sentiment survey is fix and flip investors seem to be a little more optimistic than rental investors, which is a bit of a switch. The rental investors have really held up very well going all the way back to COVID. Whereas fix and flip folks have taken it on the chin a bit, especially with the rise in conventional interest rates, not being able to sell the markets into owner-occupied homes. But that seems to have switched. What are you seeing in your lender database, and what are folks saying?
Yeah, there's definitely a clear uptick in the number of fix and flip loans that we're seeing being submitted. I think a lot of that is to some of the things that Rick's mentioned today, that just the cost of those rental properties, insurance, or some of the other problems that come with that. I also think the way that lenders have approached the situation in the marketplace is making those fix and flip loans a little bit more advantageous and a little bit more to the renter or to the investor's appetite, and making it a little bit more easy for them to execute those transactions, as opposed to deal with all the things that go into the rental side.
You know, Rick,
Yeah.
when I hear something like this, and I'll let you comment on it, but this is one of the things that pops into my head, which is, have owner occupied folks finally said to themselves, this is where the interest rates are. I've got to buy a home. And when fix and flip investors are sending those homes into the marketplace, it's giving the investors some certainty now that the buyers have really just sucked it up and realized they got to do what they got to do.
I wish I could say the answer to that was yes. I think the answer is more like maybe in some cases. And the other answer that I always give my kids that they love so much is it depends. Let's kind of peel back the onion on a couple of these things we've been talking about. Why are rental property investors less optimistic or less happy than fix and flip investors? I think Jacob started to get to some of that. If I'm a rental property investor and I've done my math to figure out how I turn a profit on my rental units, and suddenly I get an unexpected insurance bill where my premium is doubled, and I didn't calculate in the fact that property values have gone up by 40% in the last 3 years, so my taxes are going to follow. Suddenly I could go from a position where I'm making a reasonable profit to where I'm underwater. And I don't necessarily have that quick out that the fix and flip investor does from a profit standpoint. So, because I'm committed, I'm a long-term investor here. I'm basing my profitability more on cash flow than on property value appreciation. And so those incremental costs that I hadn't budgeted really come home to roost. The other issue that these folks are facing is there's a lot of downward pressure on rents right now. And that's because between last year and this year, we're looking at 1 million new apartment units coming online. That's a flood of inventory entering the market. And in some markets, we're probably looking at an oversupply situation, at least temporarily. So that drives rent prices down. I'm now competing with brand new, brand new apartments with lots and lots of bells and whistles that look really enticing to that renter. So the competitive market is very difficult for rental property investors right now for a variety of reasons. If I'm a fix and flip investor, is it easier to sell a house today at the price I would have charged a couple of years ago than it was maybe 6 months prior? Maybe a little. Affordability is still a real issue, but I think with fix and flip investors, it's more a question of bouncing up off the bottom. We were in a situation where I think we'd had 4 consecutive quarters where there were fewer flips than there were the prior quarter. Gross margins were going down really for the last year. And in the second quarter of this year, for the first time in a while, we actually saw the number of flips go up quarter to quarter. And we saw an improvement in gross margins. Now, the gross margins I'm referring to are about as gross as they get. It's how much did you pay for the property and how much did you sell the property for? So it's not taking into account any of the operating or financing or insurance or labor construction expenses. It's just dollars outlaid versus dollars captured. But the fact that it was moving up on a quarter over quarter and year over year basis was cause for optimism. The other reasons for optimism for flippers are that we're seeing more properties being listed for sale. So inventory numbers are up about 40% year over year. They're still only about half of what they were in 2019, but way better than they were a year ago. So there's more options for a flipper to pursue to buy in order to be able to resell. And the properties that are coming to market with much more rational pricing than they were a year ago. So all of those conditions combined, I think, make it a more optimistic time for flippers than what we would have seen in recent quarters. In terms of your question about home buyers and are they biting the bullet and just accepting that this is the new normal, we've actually seen demand weaken a little bit in the last month or two. And speculation is that those would-be buyers are now of the opinion that the Federal Reserve is going to reduce the Fed funds rate and mortgage rates will come down a little bit more. And so they're biding their time waiting right now. I think we're seeing very similar patterns of both demand and supply. And that is that people that need to do something are doing something. People that have options are basically just holding off. But you do see properties coming to market because somebody gets married or they get divorced, they have a kid or there's a death in the family, there's a job loss or a new job that requires a transfer. And in all those cases, we're seeing properties listed and we're seeing buyers come to market. But affordability is still almost as bad as it's ever been in the history of the housing market, as far back as the data goes. And until we start to see wages make things a little bit more affordable, home prices continue to settle down, and ultimately those mortgage rates go down, I think it's going to be a slow recovery, Jeff, rather than somebody flipping a switch and everything feeling a lot better.
So let's go macro for a bit. One of the questions that we ask in the investor sentiment survey is, what do you think the economic conditions are going to be? And we ask that through, are you expecting a recession? This go around, 58% of the respondents said they are still expecting a recession. Is that still a thing, Rick? I feel like no one's talking about recession anymore.
No, they're not. You know, it's kind of ironic that we saw a positivity increase of 16% in the quarter over quarter numbers from investors, and that almost 60% of them are expecting a recession. It does make you wonder a little bit. Although the slightly cynical part of me thinking that if I'm a fix and flip investor, a recession might not be the worst thing in the world, because job losses, more defaults, more low-priced properties for me to get my hands on, and ultimately the recession goes away, and I can sell the property. If we're looking at the macro economy, the odds of a recession seem to continue getting lower and lower. It does appear that the Federal Reserve may have tap danced its way out of this, and executed that legendary soft landing. There are really no signs in the economy right now that point toward a recession. There are some signs that point toward consumer finance weakness. Consumer debt is at an all-time high. We're looking at almost $18 trillion in consumer debt. Most of that's housing debt, and that's offset by record levels of homeowner equity. But there's $7 to $8 trillion of consumer debt out there that's, $1.3 trillion in credit card debt, an all-time high, 1.6, 1.7 trillion in auto loan debt, 1.5 trillion in student loan debt, at a time when interest rates on all that credit is going up. Credit card interest rates are 25, 30% these days. And we're seeing delinquency rates in those categories go up. So there are some indications that the consumer is weakening a little bit. And at the risk of sounding cavalier, and I don't mean to, there's not a great deal of difference between a soft landing as the economy slows down or a very mild recession, which is what most economists had been predicting. We'll still see unemployment go up a little bit, maybe into the high fours, maybe 5%. We'll see we'll see wage growth slow down a little bit. We'll see job creation slow down a little bit. And a lot of this driven by a slowdown in consumer spending. We're starting to see a little bit of an indication of that. But it really doesn't look like we're going to have what would technically be referred to as a recession anytime in the near future.
Are lenders talking to you, Jacob, today about macro conditions and how that influences their business?
Not as much as they should be, to be honest with you, Jeff. I think just going back to the importance of this information in the data that's collected during this sentiment survey, everybody needs to be aware of what the market's doing and how investors feel in that market. I think that the conversation needs to be more widespread from lender to lender and all the way down to our investors. So I think, more lenders and more people, professionals in our area, in our space, need to be using resources like this to make better decisions moving forward.
And I think you touched on something there, Jacob, which is, you know, at the end of the day, and Rick, I'll bring you in as well. Lending is a local business, right? You know, we often paint, especially here as RCN's national lender, we lend everywhere. Rick, you're an expert in the entire United States. We often paint things with such a broad brush. But at the end of the day, and you touched on it before, Rick, there are markets that are hurting right now, and lenders are really, for the most part, concentrated in local geographies. And that's how they're going to make their decisions. Maybe let's talk for a minute about what, and I'll go back to you again, Jacob, what lenders are saying about their local markets versus more regional or national activity. And the same to you, Rick.
Yeah, I mean, I would say first and foremost, I think it's easier for lenders to have more localized and specialized knowledge within their backyard, right? You have a little bit more of a finger on a pulse of what's going on legislatively and the laws and things of that nature that may impact these types of loans. And then on a wider basis, I think that it's just harder to predict and expect what's going on outside of your market when you try to reach too far. One of the questions that I actually had queued up for you, Rick, today was regarding this. We're seeing through the survey, a lot of investors plan to do less in states like New York or California, places where we typically see a lot of volume. And we saw other states like Florida, New Jersey, or even Georgia expecting an increase in volume in those states. I have to assume that this has something to do with that, right?
Yeah, it really does. It's a great observation, Jacob. The migration that we saw in large numbers during COVID, people exiting, high cost areas, and densely populated areas in a search for better health conditions, and for more affordable lifestyles has continued. Not at the same level, but it's continuing. And we see states, particularly California, New York, and Illinois, continue on a net basis to lose over 100,000 people a year. So in the case of California last year, there were 300,000 more people that left the state than came into the state. And so it's not terribly surprising that investors are planning to buy fewer properties in a state, in that condition. On the other hand, Florida and Texas generally have been number 1 and 2 in terms of population growth over the last few years. And the population growth we're talking about is not organic, people having lots more babies. It's people moving there from other places across the country. So yeah, I mean, what I tell investors, and I think this holds true for lenders as well, is you look for markets where population is growing, where jobs are growing, or where wages are growing. And typically, if you have those 3 things, you're going to have a pretty healthy real estate market. And if I'm an investor, I'm going to be looking at those markets as being the biggest opportunities. We mentioned Florida and Texas, and I should throw out something that is just kind of I thought an interesting tidbit. The builders may have gotten out ahead of the curve a little bit in those 2 states. We are seeing a lot of inventory popping up in Florida and in Texas. And as a result, we've seen home price appreciation slow down in those 2 states pretty dramatically. In fact, in some markets, we've actually seen year-over-year price declines. So, the whole supply demand thing is something that people do need to keep their eye on, whether they're investing in their local market, or they're maybe even more important if they're looking to invest somewhere across the country, where they're not actually there to manage what's going on.
So that's a great segue into new construction. We haven't touched on it at all in this monthly update. How are the national builders performing? Are they getting ahead of their skis? It seems like maybe they are in some areas, but maybe they're just really adjusting to more normalized pricing.
So builders have been building more over the last year. I think there's about 1.6 million properties under construction right now, which is a good number. But if you look at housing starts and permits, they're weakening a bit. And I think they're doing that because builders today are much more in tune with market trends than they were, say, 10 years ago. We got caught with a huge oversupply of homes back in 2008 when the market crashed. And the builders had just kept building even after buyers had stopped buying. And they're much more in tune with what's going on, I think, in today's market. We're still somewhere between 1.5 and 3 million units undersupplied, housing units across the country. So the builders could keep building as long as they were building in the right places. But I think what we're seeing in Florida and Texas are probably anomalies. I think we saw very strong growth trends. We saw price increases, outpacing the rest of the country. Builders got excited, probably a lot of local builders, to be honest with you, rather than the national guys. And now they've had to tap on the brakes. But we're in no real danger of being oversupplied from a housing perspective anytime soon.
Well, the documented secret sauce of the national builders especially has been them contributing to rate buy downs, which is making these homes affordable. Is that still continuing today, Rick?
Yeah, the number one concession offered by builders to buyers today is buying down the rates of a mortgage. I think I've mentioned this before, but speaking recently to a group in Denver, I saw a local builder advertising 4.9% mortgage rates on a 30-year fixed rate loan. And this is at the same time when the price of new homes has come down significantly from peak a couple of years ago, while existing home prices have gone up. So you have a few things happening right now. You have the gap in the median price of a new home versus the median price of an existing home being much narrower than it's been in years. You see those favorable mortgage rates because the builders are paying points to buy down mortgage costs. And you see other concessions that builders are making in terms of upgrades and so forth. So, for people looking to buy a house, the other consideration, Jeff, is candidly, new homes are more readily available. There's about a 9-month supply of new homes available compared to about a 3-month supply of existing homes. So there's more inventory to choose from. The prices are favorable, and the mortgage rates are, as you said, much more advantageous when the buyers are incented that way.
And once again, going macro, you mentioned the shortage of housing in the United States. The builders are certainly chipping away at it.
Mm-hmm.
Maybe you could just talk for a minute about the actual creation of demand. I know there's a certain amount of destruction every year of demand versus, what's being created. And if we continue on the pace that we're at with this building supply, I don't want to call it a boom by any means. Will we eventually get caught up? What do the numbers say?
Well, there's two things there. One is what the numbers are telling us, and even with the pretty significant increase in housing starts and overall construction that we've seen over the last couple of years, we're just now back to about the 20-year average. So we're not building above average numbers of homes right now. We're getting back to more or less normal, but we had a 10-year gap where we underbuilt. And part of that underbuilding, to your point, Jeff, is destruction of existing inventory. The other part, this is the second number, is demographics. And right now, we have the largest number of young adults between the ages of 25 and 34 in the history of the country. That's prime age for household formation. That's prime age for being a first-time homebuyer. And that demographic wave will continue for the next probably 2 years, maybe a little longer. And then it starts to slow down a bit. So the demographics slowing down as older homeowners exit the market, either because they no longer own the home or they've moved on to their heavenly reward. That opens up some of that inventory as well. And we do have an aging population, so there is that to consider. So the combination of builders building more, demographic patterns starting to slow down a little bit. Ultimately, you have a chance to catch up, but it's not something that's going to happen overnight. And there's also a wild card in here, which is immigration. And we're talking here pretty specifically about legal immigration. But as a nation, economically, we need more legal immigrants, immigrants coming in with jobs. for a number of reasons. One is it keeps consumer spending going the direction it is. And also because we need more workers to pay for entitlement programs like Social Security and Medicare, because we have a huge number of retirees as the boomers age out. So those immigrants coming in need housing as well. So depending on how many legal immigrants we have coming in, that could offset the slower demographic trends we're seeing in terms of current population. So there's a lot of moving parts that go into this. But again, I think the net is we remain undersupplied in terms of overall housing, probably for at least the next few years.
So I want to finish sort of where we began today, which is the investor sentiment survey and index. And Jacob, maybe just your high level thoughts on what you got out of this sentiment survey and what lenders are telling you.
Yeah, I mean, first and foremost, this information, this data is so valuable, Rick. I just want to thank you and RCN Capital for partnering together to provide this to our industry because it is so valuable and so needed. Our partners are already starting to utilize this to make their decisions and really just pass this information along to their investors as well. I personally love data and I love to look at things like this because it just makes your conversations hold that much more weight and you're allowed to really dissect and get into somebody's head about where they're going and what their business model looks like. So the last point that I'd make about both the survey and the index itself is data sometimes can be a little bit overwhelming, but the way that this information has been prepared and put together, it's very easy to read and very easy to digest and utilize that information to make those decisions. So thank you again, Rick.
Rick, your thoughts?
I think investors tend to be a precursor to overall market trends. And so I'm very heartened by the fact that investors are taking such a positive outlook, not just at today's market, but especially at tomorrow's market, because I think that bodes well for housing in general, and housing is such an important part of the U.S. economy that a strong housing market always contributes to a more robust economy. So I think the fact that we saw a 16% lift in investor optimism, on a quarter-over-quarter basis, we hit the highest number we've seen in the 5 quarters that we've done the survey. All bodes very well for housing in the future.
Well said, Rick. Once again, a ton of data in this particular monthly update. Thank you so much for joining us. And thank you, special guest Jacob.
Thank you, guys.
Really a really insightful monthly update. And we'll look forward to seeing you again next month.